This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, August 24, 2026, and this is the New York pre-market. Now, let's get into it. The VIX is at 15.13, yet the market is quietly rotating out of duration-sensitive sectors. Utilities are down 3.48% on the week, while healthcare is up 4.33%. Capital is moving, but volatility is sleeping. That disconnect is the story of the close. Looking ahead, the economic calendar is light today but packed for tomorrow. Tomorrow, Tuesday the 25th, brings housing starts and building permits, followed by new home sales and Case-Shiller home prices. On Wednesday, we get durable goods orders. Today, the focus remains on the structural shift in sector performance. Let's look at the snapshot. The S&P 500, tracking via SPY, is at $765.72, up 0.41%. The Nasdaq 100 via QQQ is at $713.44, up 0.35%. The Dow via Diamonds is leading at $532.22, up 0.89%. The Russell 2000 via IWM is at $299.96, up 0.77%. But the real story is in the sector ETFs. The materials sector, are up 2.14%, while the utilities sector, are down 2.28%. The technology sector, is barely up 0.11%, but down 3.53% on the week. The headlines driving this rotation are clear. Steel stocks SDLD and NUE are gapping up 4.5% and 4.1% respectively, driven by tariff narratives and industrial demand. On the earnings front, PDD is up 3.3% pre-market ahead of an earnings per share estimate of $2.69, while MSTR has gapped up 3.2% on a $5.10 billion reserve raise.
The MSTR move is interesting because it shows institutional capital seeking alternative yield when traditional rates are high. But the PDD move is more critical for the broader China tech narrative, especially with Barber plunging on share offering news. The market is trying to price in a recovery, but the headwinds are significant.
Let's start with the broad market structure. SPY is at $765.72, holding just $3.68 above the August 20 low of $762.04.
SPY 10-day range is $762.04 to $779.37. We are currently sitting at $765.72, which is technically support, but it's fragile. The volume profile shows accumulation in the $762 area, but the QQQ is telling a different story. QQQ is at $713.44, compressing hard toward its 10-day low of $708.52. The range has contracted from a high of $734.58. That compression is a volatility squeeze waiting to happen.
But the VIX is at 15.13, down 0.88. That compression in volatility is masking the sector divergence. The crowd isn't pricing in a breakdown yet. They're seeing the SPY hold and assuming the QQQ weakness is just noise. But the volume anomalies in microcaps. FNGA down 95.1% and JGGC down 76.2%, with 6.41 million and 3.7 million shares respectively, suggest speculative liquidity is evaporating. The complacency in the VIX is dangerous because it ignores the risk-off sentiment in the smaller names.
I agree with Pulse on the risk, but from a charting perspective, the QQQ testing $708.52 is the immediate technical trigger. If that level breaks, the next support is undefined in the current 10-day structure. The SPY holding $765.72 is a lagging indicator. The Nasdaq is leading the decline.
Let's pivot to the sector rotation. The materials sector, are leading with a 2.14% gain, while the utilities sector, are collapsing down 2.28% today and 3.48% on the week.
This is a classic flight to tangible value. The 10-year Treasury yield is at 4.74%, and the CPI is sticky at 3.3%. That yield environment makes utilities unattractive because their dividend yields can't compete with risk-free rates. Meanwhile, materials are benefiting from tariff concerns and industrial demand. We're seeing capital flow out of duration and into assets with immediate cash flows. The sector divergence is structural, not cyclical.
And that's the risk. The 4.74% yield is actively cannibalizing the equity risk premium. When the risk-free rate is that high, you see deleveraging in rate-sensitive sectors. The utility sell-off isn't just about yields, it's about valuation compression. The MSTR $5.10 billion raise is a signal of this stress. Corporates are raising cash because the cost of capital is too high to sustain growth multiples. The market is repricing duration, and utilities are the canary in the coal mine.
The sentiment data confirms this. Healthcare, the healthcare sector, is up 4.33% on the week with the highest volume accumulation. Investors are buying safety, not growth. The VIX at 15.13 suggests they think this rotation is benign, but the micro-cap liquidations suggest otherwise. The risk-off sentiment is real. It's just concentrated in speculative assets right now. Let's look at technology, the technology sector. It's up only 0.11% today, but down 3.53% on the week. Pre-market, NVDA is down 3.7% and MU is down 3.8% on short-selling news from Burry and valuation concerns.
The pre-market gaps in NVDA and MU are fundamental reassessments. The AI CAPEX sustainability is being questioned. This isn't just technical, it's a shift in institutional positioning. The neutral news sentiment on NVDA, plus 0.8 and MU, plus 0.12. Despite the price drops, shows the market is pricing in bad news before the earnings prints. The earnings risk is the primary driver here.
Technically, the triple Q is testing $708.52, which is the August 20 low. If that breaks, the technical structure for tech is broken. The 10-day range was $708.52 to $734.58. We are at the lower bound. The volume on the decline is increasing, which confirms the bearish momentum. The SPY holding $765.72 is irrelevant to the triple Q's structural weakness.
And that's the trap. The SPY is holding because of the defensive rotation into the healthcare sector and the materials sector, but the triple Q is leading the decline. The 4.74% yield is the gravitational anchor. The technical support at $708.52 will be ignored if the yield holds above 4.74%. The market is not looking for support. It's looking for a new valuation baseline.
Let's talk about healthcare, the healthcare sector. It's up 1.29% today and 4.33% on the week, showing the highest volume accumulation among major sectors.
This is the defensive anchor. With CPI at 3.3% and core PCE at 3.29%, the Fed is on hold with rates at 3.63%. Healthcare is benefiting from stable cash flows and low sensitivity to interest rates. The volume accumulation is institutional. This is a safe harbor in a rotating market.
The sentiment divergence is clear. While tech is under pressure, healthcare is absorbing flows. The VIX at 15.13 suggests the market thinks this is a healthy rebalancing, but the micro-cap distress suggests otherwise. The rotation is real, but the complacency and volatility is a risk. Finally, let's look at the micro-cap distress. FNGA is down 95.1% and JGGC is down 76.2%, with extreme volume anomalies.
This is the risk flag. The lack of bid support in sub-minus $5 equities indicates a severe liquidity crunch in speculative assets. The 6.41 million shares in FNGA and 3.7 million in JGGC are not normal trading volumes. They are distress liquidations. This is a precursor to broader risk-off if the rotation spreads. The 4.74% yield is forcing capital out of risky assets, and microcaps are the first to go.
Technically, these are not assets with support levels, they are liquidation events. The volume spikes confirm the lack of buyers. The triple Q testing $708.52 is a more meaningful technical level for the broader market, but the micro-cap distress is a leading indicator of liquidity stress.
Here is the synthesis. Grid flagged the triple Q testing $708.52 as a critical technical level, and CIPHER confirmed the fundamental headwinds from NVDA and MU earnings risk. SPECTER highlighted the liquidity stress in micro-caps as a leading indicator of broader risk-off. Pulse pointed out the dangerous complacency in the VIX at 15.13. The market is rotating into healthcare and materials because of the 4.74% yield, but the low volatility suggests this rotation is underpriced. The risk is that the triple Q breaks $708.52, triggering a broader repricing of duration.
Key takeaways from today's analysis. First, the VIX at 15.13 is masking a structural rotation away from duration-sensitive sectors like utilities and tech. Second, the 10-year yield at 4.74% is the primary driver, forcing capital into healthcare and materials. Third, the triple Q is testing $708.52 support, and a break could trigger further downside. Tomorrow, watch housing starts and building permits for any shifts in the macro narrative. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.